Good morning, investors, and welcome back to the Daily Hunt for Multi-Baggers. It's Friday, April 3rd, 2026, and we're here to dive into yesterday's market chatter and AI-generated insights.
That's right, Ethan. Our systems have been buzzing, flagging quite a few distinct stocks across various sectors. What's interesting is we saw a lot of high conviction, both bullish and bearish, in the social media discussions. It feels like a day where sentiment is polarized, which means we've got some really promising candidates and some clear stay-aways to dissect.
Absolutely. Today's analysis covered a good number of posts, and while there weren't too many different tickers, the sentiment around them was really strong. We've got a mix, I'd say, a bit risky on some fronts, but definitely some promising growth potential bubbling up too.
Let's kick things off with VCX, the Fundrise Innovation Fund. Our analysis pointed to an overwhelmingly bearish sentiment there.
Well, it's an interesting concept, offering exposure to high-growth private companies like OpenAI, SpaceX, and Anthropic. That's where innovation is truly happening, and for investors wanting a piece of that action, VCX could theoretically offer that bridge. There's definitely a long-term vision of growth in those underlying assets.
Theoretically, Ethan, is the key word. When you look at the KPIs, it's a stark picture. The current price of $113 is over 5 times its net asset value of $20 per share. That's a massive premium for a fund. And let's not forget the zero net profit margin and operating margin. This company isn't generating profits from its core operations. Combine that with the impending share lockup expiry in September, which users are predicting will flood the market with shares, and you have a recipe for potential volatility. We've rated VCX a stay away several times before, and frankly, the data continues to support that.
Yeah, the disconnect between price and NAV is definitely a red flag, and the historical volatility is certainly notable.
So for VCX, based on the current data and those financial health metrics, our AI-generated insight remains a stay away.
Moving on, let's talk about WTI, W&T Offshore Inc. The social media buzz around this one was strongly bullish, but it was really more about the broader oil market, Users are making aggressive bets on crude prices soaring due to geopolitical tensions, even noting how much it costs to fill up their cars. If oil prices keep climbing, that's a massive tailwind for any oil and gas producer like WTI. We've seen their stock already climb about 183% in the last year, which shows some market reaction to this trend.
That's true, Ethan. The macro environment for oil is undoubtedly bullish, but we have to look at WTI, the company, and its financial health. Their KPIs are quite concerning. We're looking at a negative price-to-book ratio, which indicates liabilities exceeding assets, a serious red flag. They also have negative net profit margins and negative earnings per share. While rising oil prices could eventually boost their revenue and hopefully profitability, the company is currently operating at a significant loss. This isn't just a minor blip, it's a fundamental financial weakness. Our previous ratings for WTI have also consistently been stay away, and for good reason.
So even with the tailwind of high oil prices, you're saying the company itself isn't in a position to fully capitalize?
Precisely. The bullish sentiment is for oil, not necessarily for this specific company's ability to execute and overcome its deep-seated financial weaknesses. So for WTI, our analysis suggests a stay away.
All right, next up is NVIDIA, NVDA. And it seems like the bullish momentum just keeps going strong. We saw several discussions, and the sentiment is overwhelmingly positive. People are talking about NVIDIA scaling its AI infrastructure, making strategic investments, and the sheer market influence it has. There's chatter about new chip generations like Blackwell and Rubin potentially generating $1 trillion in lifetime sales. Plus, the significant net insider purchases, that tells you a lot about internal confidence, doesn't it?
It really does, Ethan. While the stock has seen a few stay-away or speculative gamble ratings in the past due to valuation concerns, the recent data is compelling. NVDA boasts phenomenal revenue growth at 73.2% and an incredible net profit margin of over 55%. Their return on equity is over 100%, showing outstanding efficiency. Yes, the price-to-earnings ratio of 36.20 is high, indicating the market has priced in a lot of future growth. But given these robust growth and profitability metrics, coupled with that strong insider buying and the news about strategic investments like the $2 billion stake in Marvel, it's hard to argue against its fundamental strength. Even with some reports of losing ground in China or certain institutional selling, the overall picture from our AI-generated insights points to continued dominance.
It sounds like the company is truly firing on all cylinders, and the market sentiment reflects that.
Absolutely. For NVDA, our analysis points to a clear buy. It's been a buy multiple times recently, and today's insights reinforce that.
All right, let's quickly recap our AI-generated market commentary for today. Investigate as buy, NVIDIA, NVDA. Investigate as cautious buy, none. Investigate as speculative gamble, W&T Offshore Inc., WTI.
That's all for today's market commentary on the Daily Hunt for Multibaggers.
This podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice.
Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred.
The market is a wild place, and knowledge is your best asset. Thanks for tuning in, and we'll catch you next time.